Hey everyone, welcome back to my channel. So today we're going to talk about the power of long-term investing and compound interest. So what comes with that is simply this. After years and years of studying different methods and going through, different investing strategies, especially in the stock market, you start to realize that there's one specific method that will work for you. And I'm not someone who says that you should just be a dividend investor. You can definitely have some long-term buy and hold stocks that are not dividend stocks. You can have growth stocks like Amazon, Tesla, um, Google, Netflix. Those were doing really, really good for some time. And then Amazon, Google, and Tesla are still doing very, very well, among a few others like Berkshire Hathaway. Those are all growth stocks. They don't give you a monthly dividend. You must sell them in order to reap the gains. However, those growth stocks typically grow at a faster rate than dividend stocks, right? And so if you're looking to see double your money, go from 500 to 1,000 in a year, the likelihood of that happening is more likely with a growth stock than a dividend stock. However, over time, you can see the effects of compound interest working in your favor. For example, Apple is a dividend stock. If you had invested in Apple from day one, you would have more than 5 times your money, right? But same thing can be said about Tesla, that is a growth stock, where if you had invested in from day one, you would have more than 6 times your money. And so over the course of a 5-year period, which one is truly the best strategy? Well, you don't want to truly just invest in one stock, period. You want to diversify. You want to get in with a lot of different companies, a lot of different businesses that you personally believe in. So when it comes to my stock investing strategy, it is very, very similar to Warren Buffett, believe it or not. In real estate, I try to pull from many different minds and many different resources. But when it comes to investing in stocks, Warren Buffett is my go-to. I believe that we are most aligned in that regard. And so my stock is heavily dividend stock based. I have over 32 companies and only 8 are in the red as of this video. And I'm still profitable in its totality, because I chose companies that I personally believed in. So although 8 out of the 32 companies that I have invested in are in the red, what I see is that they're discounted rather than a company that is just not good, right? And then every year, at the beginning of the year or right around December, I reevaluate my portfolio to determine if I want to keep this stock. So if the stock is in the green or in the red, I want to know what their future plans are, how they plan to expand, what do they plan to do in order to maintain or gain more profit share. What are they doing in order to advance their technologies, their fields, their resources in order to expand their business? And does that align with me? This is a lot of work to pick individual stocks and individual dividend stocks. And if you're not someone who can do that, then you should stick towards ETFs. You should stick towards, you know, a share that encompasses multiple companies like your SPY or your SPD or your VOO. Those type of ETFs will allow you to just invest in 500 or so companies all at once, or invest in sectors like technology, car, automotive, whatever it is that you plan to invest in, restaurant industry stocks, right? And a lot of these companies are going to be hit hard, especially the restaurants, especially the car automotive industry, because we're going to go through a period where interest rates are so high and there's a lot of job loss, people just won't be able to eat out. But All that means is that companies like Walmart, Sam's Club, all those companies are going to make more money because people will need to eat more at home. That's just, again, my opinion, some random guy on YouTube, but that will tell you where the market is going to go. So what companies are going to go down a bit versus what companies are still going to go up a bit based on the economic factors. When times are better, surprisingly, you'll probably see less people eating at Walmart and more people dining out, right? So stocks like that pays so stocks like, I forgot the restaurant stock, I believe it's DSR, that pays every single month. That pays every 3 months, and you can invest in Burger King, Popeyes, all this stuff, Chipotle, all in one. That one is probably gonna do a run up, and I should actually check that stock and see if it's in the gutter. Because if it's in the gutter, I'm probably gonna want to pick it up and buy some. Because who doesn't want a heavily discounted stock when everybody's fearful? I mean, I do, right? So if I can make a lot of returns and I feel that ETF has bottomed out, then I'll be more than happy to invest in those shares. So with that being said, why dividend stocks? Why do I personally choose dividend stocks and stock market in my stock market investing journey? And why do I only have like 2 or 3 growth stocks out of a portfolio of over 32 companies, which means I have at least 28 dividend stocks? Well, the answer is because one, I'm young. A lot of old people, or I should say older people, use this as an excuse to not invest in dividend stocks. And it is a valid excuse. I'm younger, so I can utilize compound interest. Compound interest is very, very exciting for me, although it can seem boring. And here's why. When I invest $100 at 1%, over the course of a year, I get $1 back from my dividends alone. That means over a 12-month period, I made at least 7 to 8 pennies every single month until I generated $1. But when you have a dividend stock, that $1 is also gaining 1%, right? So now that $1 has made me 1 penny over the course of a year. So now going into next year, I have $101.01, gaining 1%. I might gain $1.01 again the following year. But then in year 3, I now gain $1.02 without having done anything. But that is the power of compound interest. It seems really, really, really slow. But that is not the method that I do. I don't just put $100 in and leave it there to gain 1%. And obviously 1% is very, very low in a time where you can invest in a savings account and get a 4% interest rate. So why invest in the stock market? Well, the dividends that I receive is not 1%. It's actually like 2.25%. So that's just the dividends. That doesn't mean that the stock hasn't grown either. I actually invest in growth dividend stocks. So I might buy a stock at $50 and it gives me 2.25% dividends. But then it goes up to $55 just by growing. So I bought in at $50, but now I get a dividend payout at $55. So that was an extra $5 that I never put in that I'm receiving dividends on. On top of that, I invest every 2 weeks. So that new money is gaining a dividend. And then that dividend is gaining a dividend. So again, that same dollar is giving me a penny. That penny is giving me a hundredth of a penny. And that 1/100th of a penny is giving me a hundredth of a penny. So If I invest $100 every month, the dividends alone will give me $10 a year. That $10 a year is going to give me about 10 cents a year. That 10 cents a year is going to give me blah, blah, blah. And then as I continue to invest another 100, another 100, another 100, what happens? I now get $20 a year the following year and 20 cents a year from that dividends, and then 1 penny from that dividends. And then that dividend gives me another dividend. And so after 5 years, you're now looking at $120. Your dividends is now giving you $100 a year. You're putting in $100 a month. Another 10 years pass. Your dividends is giving you $250 a year. You're only putting in your dividends is probably giving you $200 a month. Meanwhile, you're only putting in $100 a month. Now your dividends is giving you more money than you're even putting in. That's the power of compound interest. When your dividends is now making more money than you can put in yourself, you've hit the jackpot, you've hit the lottery. And that's really what I'm waiting for. When the money that I put in is no longer as much as the money that I'm getting out of it. And so I'm almost there. In about 3 years, there's no way that I will be putting in more money than I'm earning in dividends, because I'm already at a point where, because I do this lump sum every January and then I invest every month, that monthly payment that I invest is a lot smaller than the lump sum that I do every January. So I'll be so much closer to that 2-week investment that I do versus that lump sum payment that I do every single year. And with that dividend being at 2.25%, when we are in better times than we are now, the growth in those stocks are going to exponentially transform how much I'm getting paid in the dividend sector. So for a young investor like me, who is going to go through at least 4 more cycles of good business and good market times, and then also recessions, this won't be the last recession that we go through. But by the time we go into our next recession, I will have had so much money in dividend stocks investing that it won't make any sense. So if you're young, if you're 35 and under, and you're thinking about a new investing strategy that is going to take you well into your 60s, then I'm a big advocate for dividend investing, because in the long term, you'll be able to reap the benefits without having to sell your portfolio, and you're going to be able to take the dividend while leaving your initial investment in there over time. So it's a win-win for sure. I don't really see a lot of downsides to dividend investing. It's slow growth at the beginning, but it is transformational as time goes on. Make sure you subscribe if you like these type of videos. You know I post every single day at 8 a.m. daily on YouTube and Rumble, and I can't wait to see you on the next one. Peace.